Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I'm joined by a bevy of my colleagues. Of course, there's Cris. Cris, hey, Cris, how are you?
Doing well.
That's good. And we're missing Ms. Di Natale again. I guess she's not
Yes,
feeling
we are.
well. Yeah, COVID.
She'll be back soon. She'll be back soon.
She'll be back soon. So we'll miss her. But in her stead, we've got four other folks, colleagues. We've got Juan Pablo Fuentes. JP, how are you?
I'm good, Mark. How are you?
I'm always good. I'm
Okay.
always good, Juan Pablo. Yeah, and I'll explain in a minute why we've got this bevy of economists. But just to finish the introductions, we've got Mike Brisson. Mike.
Hey, Mark, how's it going?
And I should say Juan Pablo is an expert on energy markets, oil markets, and Mike is our expert on the auto vehicle market. And maybe you're kind of figuring out now what the topic at hand is going to be. I'll give you one more hint. We got Bernard Yaros. Bernard, how are you?
Good, I'm doing well. Good to see you, Mark.
He's the Renaissance man. I won't explain. I embarrass him every time he's on, but I won't do that this time. And Martin Worm. Hey, Martin.
Hey, Mark. How you doing?
Good. And the thing about Martin is I always get the city he's in wrong. I keep saying Portland, I think, but you're actually saying Seattle.
Yeah, I'm in Seattle, and this very much goes with sort of East Coast stereotypes about the Pacific Northwest out here. It's where you go
Right.
to live with your spinster aunt, and it's all kind of in the woods somewhere.
All I have to say is, Martin, you look like you belong in Portland. I don't know what that means exactly. Don't take it the wrong way, but
Yeah, it's the I will say this. I come off surgery, so I haven't trimmed my beard, and I was going to do it today, but my wife hates the hair, so I didn't quite get to it.
is smoking a reefer in Portland? Oh no, you're in Seattle. You're
In Seattle.
Is that legal?
Well, it is legal by state law, but of course not by federal law. I will say that. And it's about the general look here. I think what we're referring to is more closing time at the lumber mill, and I've adapted that since I've been living here. Not so much the habit.
Okay, very good, very good. And Martin's going to focus on. He's our expert on all things monetary policy. Of course, Bernard obviously is on the federal government. Listener, are you figuring this out yet? What's going to go on here, or what we're going to do? We're going to have this may be the title of the podcast. I'm not sure. What could go wrong? And, we've been, I think relatively optimistic about the economy's prospects, pretty consistently so, saying, yeah, recession risks are high, but we think we'll be able to get through this period without an actual NBER defined recession. And I'll have to say, too early to declare victory here on that one, but it's feeling pretty good at this point. Inflation's been coming in very nicely. It's not going to be a straight line back to the Fed's target, but it's going to take some time, but we're headed in that direction. And that's all happened without a single basis point increase in the unemployment rate, which is pretty incredible. So, things are going pretty well, certainly compared to the fears. And the purpose of this podcast is going to be focused on what could go wrong. What could send things off the rails here. And, obviously recession risks are still high. The economy is still very fragile. We're not growing very quickly. And in that context, if anything doesn't kind of stick to script here, we could go into recession. So recession risks are high. So each of my colleagues here are going to be focused on one of those what could go wrong things. And I thought we'd organize this in terms of what is the most immediate threat to what would be a kind of a longer term threat. So we're going to begin with oil prices. But before we go down that path, the other thing that happened this morning, right before we started the podcast, is Jay Powell, chair of the Federal Reserve, gave his speech at the Jackson Hole confab. And I thought it'd be useful just to get a sense of what he said and what it means. So maybe Martin, because you are the expert on monetary policy for us, what did the chair have to say?
Yeah, so in many ways, the meeting was, I guess the speech was perceived as a little bit hawkish, but it was certainly much less hawkish than it was a year ago when the Fed really pivoted on inflation. The mainline narrative continues that the Fed remains committed to the 2% inflation target and will essentially do whatever it takes to get there. The particular points of concern that the chairman spoke about a little bit is the fact that consumption growth still looks remarkably stable. The economy hasn't quite cooled as much as the Fed would like to see, that labor markets haven't quite softened as much. In part, that leaves open the probability of another hike at one of the next two meetings, but what it will certainly mean beyond that is the Fed is going to start cutting rates much, much later than we previously anticipated. If you go back to March, markets thought that the Fed might cut later in this year. By now, the expectation is really more towards summer of next year, and it will take a lot for the Fed to be ready to take that step. In terms of market reaction, we didn't see a very strong reaction, far as I can tell, as of now. Certainly not like we saw last year. So markets are still taking down in strides. So the Fed is certainly a little bit more relaxed than they were a year ago, but the risks remain, and commitment to the inflation target is sort of a strong takeaway from the speech, I would say.
So really no new news. I mean, basically reaffirming the 2% inflation target, reaffirming that rates likely will remain high for an extended period to ensure that inflation comes back into that target in a timely way. Did I get that right? Is that the message, the overarching message?
I think that's fair to say. I mean, if there is any new data point, which is really not all that new, is that economic data up until the second quarter came in a little higher than expected, which is great, of course, because it reduces recession risks. It's a bit of a double-edged sword in the sense that it also might mean the Fed will have to get rates higher for longer. That's sort of what Powell, again, stressed.
Okay. Hey, Cris, I think you had a chance to read the speech too. I actually haven't had a chance to read it. Did you want to fill any gaps there that Martin left? Or did he get that? Is his synopsis kind of complete?
Yeah, I think he got it. And the market reaction, as you mentioned, was fairly neutral. There was a bit of whipsawing, and the stock market went up first, and then it came back down. But it's kind of where it started the day, so not too much of not a very significant reaction. And Treasury yields also climbed 4 or 5 basis points on the 10-year. So which
isn't a whole lot given the volatility in that market. It seems like every day it's moving 4 or 5 basis points.
Yeah. So maybe there was some excuse.
10 basis points. Yeah.
Yeah. So clearly investors are reacting to the speech, right? Does suggest higher for longer, but or confirm, I guess, higher for longer. But nothing, to your point, out of the ordinary. Perhaps one omission, if you will, in the speech, as Powell didn't really talk about R-star, the neutral rate, at all. So that's a subject of debate among economists.
R-star being, what is that?
The terminal rate, the neutral rate of
the neutral rate
for federal funds, right? So the real neutral rate, there's a considerable debate of what that should be. So how much above the inflation rate should the
so just for the listener, though, the R-star neutral rate, equilibrium rate, is the rate that would be consistent with the monetary policy, neither adding or subtracting to economic growth, kind of neutral to growth.
That's right.
Right.
That's right.
And right now, if you look at the Fed's estimate of the neutral rate, or at least implied, looking at their projections every quarter, it's 2.5%. The nominal federal funds rate is 2.5%. Of course, the federal funds rate today is 5.25 to 5.5, so well above neutral. So monetary policy by that standard is highly restrictive. But you're saying there's a lot of debate as to, is it 2.5?
Is it still 2.5? Right?
Is it still 2.5? It could be. I think people are saying, could it be higher?
That's right. That's right. There seems to be more consensus building around maybe 3. Some even go to 3.5% because of some structural shifts in the economy that maybe when the Fed does start to cut, they won't go all the way back to 2.5. They'll land at 3, and that will be, to your point, equilibrium. So Powell didn't really engage in that part of the debate, right? And probably appropriate at this point because it is, it's more of a theoretical discussion. You can't really measure this that well, certainly not in real time. It's more retroactively, and it's more conceptual or theoretical. So I think not something that you necessarily want to engage with in a public forum like this when you're trying to still calm some nerves out there. So he committed to the 2% inflation target. I think that was important. But other than that, I didn't see much in the speech that kind of would derail investor opinion.
Okay. In our forecast, we have the current funds rate target, 5.25, 5.5. That's the terminal rate. That's the highest the rate's going to get in this cycle. That's our forecast. And the first rate cut isn't until June of next year, the June FOMC meeting. Is that pretty consistent with market expectations at this point? Do you know, Cris, looking at futures?
I just took a quick peek to see if
Yeah.
there was any reaction. It looks like markets are pretty convinced that there will be no hike no hike or cut, I guess, in September. And then things get a little bit more mixed as you look a little further out. So in November, later this year, investors, it looks closer to 50-50 between those that think that will just the Fed is done and they'll pause, and others who think that we'll have another quarter
Rate
point
hike.
hike.
Hmm.
And then again, you're seeing more of a distribution as you go further out in terms of when the cuts may start in 2024. But I think our assessment of mid-year seems fairly consistent with the market view.
Okay. Very good. Well, thank you for that. So let's turn to what could go wrong. And again, feels like the economy is kind of sticking to the script we've laid out previously with slow growth, but no recession, inflation coming in large part because the inflation was driven primarily by the supply shocks of the pandemic and Russian war. And as those shocks fade, the fallout from those shocks fade, then inflation can come back in, and we don't need a recession or even meaningfully higher unemployment to get inflation back into the bottle, into the Fed's target. In that script still being written, and it's still premature to conclude that that's right, and we're going to get through this without an economic downturn. So still a lot of risk around that. But even in in the kind of the optimism I've been expressing, there is the concern that the economy is growing slowly at best, and in that kind of environment, very vulnerable to anything else that can go wrong. And it just feels like there's a whole slew of things out there that could go wrong. And so I thought we'd use this podcast as an opportunity to hear about those threats and how big a threat they might be. And going to tackle this, what are the threats that are most immediate to those that are going to be around for a while. And I'm, obviously this isn't hard. It's very difficult to get timing here, but just roughly speaking. And so I thought we'd begin with oil prices, and this, we forecast lots of things. Some things we feel pretty confident in, some things not so much. And this is just Mark Zandi talking. I'm very curious to hear what Juan Pablo has to say. Forecasting oil prices is pretty tough to do. There's just so many kind of moving parts here, a lot of geopolitical dynamics that are difficult to gauge, and so very tough to do. So maybe Juan Pablo, I'll turn back to you, and maybe you can give us a sense of what our baseline forecast is, what are the drivers behind that forecast, and what are the risks around that forecast?
Yes, so our forecast actually has been pretty good this year. I think like we haven't.
Now, are you tooting your own horn? Are you tooting your own horn? That sounds like
Yeah.
I guess you're supposed to do that. It's like Muhammad Ali. I'm the greatest. Just keep saying it until everyone believes it. Is that what it is? The strategy?
When you write about forecasting oil prices, it's
right.
it doesn't happen too often.
Yeah. It doesn't happen too often. Fair enough.
So
Go ahead.
I feel good. We haven't made substantial changes to our forecast. Prices were lower than expected, I guess, in the first half of the year, mostly because Russia production really was resilient. Despite all the sanctions, all the pressures from the war, Russian oil exports actually haven't changed that much. So that I think that was the biggest surprise in the first half of the year. So that kept the oil market in a small surplus. So production above demand for most of the first half. Things have started to change, mostly because of the OPEC plus cut in the last 3-4 months. The latest one was a voluntary cut by Saudi Arabia that was unexpected. It's a sizable 1 million barrels per day cut from June levels. So that cut started in July, and it's gonna go through at least September. So in the face of that change in the supply, we have our forecast called for oil prices to increase from like around 80 right now to 85 in later this year and into next year. I felt pretty comfortable with that forecast 85. We already touched 85 in July. There was
Juan, is that WTI, West Texas Intermediate?
yes,
Okay,
that's
fine.
WTI. So Brent, the spread right now with Brent is around $3-4 per barrel.
So
So
for like 80,
80
85 on WTI, we'd be 85 to 90 on Brent.
right.
Yeah,
Yes.
got it. Okay.
So 90, that's our baseline. 90 for Brent in the last quarter and the first quarter of next year, and then as the prices start to gradually decline after that. So I mean, I think it's there are risks, of course. Like I think the
And
main
can I
one.
just stop you for a second? I mean,
Sure.
my sense is that bringing that back home to something that's more tangible to people, and correct me if I'm wrong, but this is kind of roughly the way I think about it. $80 a barrel oil, which is kind of sort of on WTI, which is where we are now, would be consistent with, something close to $4 a gallon for regular unleaded nationwide. That's kind of sort of where we are. If we go to $85, that may add a quarter to the cost. So we go from for a gallon of regular unleaded, we go from 4 to 4.25. If we go to, and just to give people full context, if we go to $100 barrel oil, people say $100, really? Well, back when Russia invaded Ukraine, we got as high as 120, 125, briefly, but we got there. But if we go to, $100 barrel oil, that gets you pretty close to $5 a gallon for regular unleaded. And that, of course, was the record high back last summer when Russia did invade Ukraine. Is that roughly right? Did I get that roughly right?
Yes.
Okay.
I think that's
Okay. Fair enough.
So
Okay.
that one thing that has happened, started happening last year and this year, is that we have so we track crude oil inventories, and that's a big part of the fundamentals in the market. But there is also like the products inventory, and those are really low in the US for diesel and gasoline. So that tells you there is the crack spread, which is what made mostly like how much money refineries make. That also contributes to the retail price of gasoline. So basically, tight inventories, refineries have more pricing power, and they can push prices for gasoline higher compared to like oil prices. So that's the situation we're right now. So that's why gasoline prices are actually almost at the level they were a year ago, even though oil prices still are a little bit below that.
Okay. So our baseline most likely scenario is oil stays at, goes from 80 to 85 over the course of the remainder of the year. Gasoline prices go from 4 to 4.25 through the end of the year, and then we see some moderation next year as we get more supplies into the market. Okay, that's the baseline.
Yeah, on average, we have WTI 78.5 for this year and almost 80 for 24. Okay. So not a big change next year in terms of the average for the year. The pattern is prices stay high in the first quarter and they start to slowly come down.
And in my thinking, and correct me if I'm wrong, is that the price of oil now globally is almost a calibrated price. It feels like Saudi Arabia, you said OPEC is cutting back production. It's really the Saudis, that they're cutting production in an effort to offset weakened demand for oil from China and maybe other factors to try to keep prices in that $80 barrel range, because at $80 they're making enough money to cover their nut to pay for their fiscal programs. If it's below 80, then they start running deficits, which they don't want to do. But they don't want prices too high over 90, because if it goes over 90, then they start demand destruction. People start pulling back on use, and also it just incents a more rapid transition from fossil fuel to green. Is that do you think about it the roughly the same way?
Yes, yes.
You do. Okay.
Yeah, I mean, we can prices could go up to 100, but they wouldn't stay there for long. Like the prices will react rapidly to the recession that will probably happen after that. So they don't like that scenario. They prefer more stable prices. So I think that for the Saudi Arabia, especially, stability and a reasonable price, which I think is around between 80 and 90 for them, that's their ideal scenario.
And the risks feel like, and I don't want to put words in your mouth, but they feel like the risks at this point are to the upside. That if we're wrong, it's going to be prices are going to be higher rather than lower. Is that right?
Yes, I feel less comfortable about that compared to like
Okay.
2-3 weeks ago,
Uh-huh.
just because of the latest news on China. China is going to account for like 70% of the increase in oil demand this year. So really what matters in terms of global oil demand growth is China. So yeah, we are seeing a lot of bad economic news coming out of China that has actually stopped that rally that we had in July following the. But still, I think that I will put the probability or the chances of oil topping 90 in the next 6 months at around 35%.
Oh, okay.
So it's still high.
Yeah.
I think is higher
Okay.
than the other option of like prices coming down substantially below our forecast. And I think the main reason is that the market is the fundamentals. The global balance is on deficit. So that keeps that could put a pressure on oil inventories. So low oil inventories, Saudi Arabia's apparent commitment to keeping prices around 85, 90. I think that's going to be. I can see in a scenario where they extend the 1 million voluntary cut through the end of the year. They haven't committed to the fourth quarter yet. So if they keep that in place for the last quarter and we see some more positive news in China, I can see prices getting to 90 in the last part of the year.
Okay. Well, that's consistent with my recession odds. So you're saying 35% probability that oil prices could be meaningfully higher than our baseline, which is $85 on WTI, and that's about the probability I attach to a recession occurring between now and the end of next year. So it feels consistent. And of course, oh, sorry, go ahead.
So do you think 90 will be enough to trigger a recession in the U.S.?
I think 90, we're right on the ledge. I think 100, if we get closer to $5 a gallon, I think we're toast, and that goes to the fact that oil plays such a central role, the obvious that it cuts into consumers' purchasing power, but more importantly, in the current context, it adds to inflation expectations, juices up wage growth, and fans inflationary pressures, and I think will put pressure on the Fed to do what Martin said they might do, and that is raise rates again more than once. And I don't know that it's going to take many more rate hikes on top of the higher oil prices to do us in. So again, because we're so fragile. Cris, let me quickly turn to you. Does that all sound right to you? Anything you want to add on that?
It does. The only thing I'd add is I've noticed that U.S. oil rig counts have been falling over the last year pretty quickly. Do you expect that to continue? I mean, that seems to me another risk factor that the U.S. producers won't respond in short order.
Well, yeah, I mean, obviously, I think that the shale boom, as we saw before the pandemic, that's over. Like that's not going to happen again. Still, production is growing in the U.S. It's actually going to reach a record level this year, and there is going to be a little bit more increase next year. But the rate of growth is not going to be nearly enough, nearly as high as it used to be. And the reason is, I think the main reason is, the outlook for the oil, for fossil fuels in general. We are seeing the transition. So oil companies don't want to these are usually long-term investments, and they are very cautious about making those commitments in the face of this outlook for energy transition. The other factor is productivity. So it doesn't really matter, like what the situation right now is, number of new drilling rigs are coming down, but productivity is actually increasing.
Okay.
So that compensates a little bit for the decline in drilling activity. Actually, the Energy Administration recently made a big revision on productivity for existing rigs, so that bump actual output higher. So I think that's going to continue into next year.
Okay.
Don't
well,
expect
let's,
a big jump in drilling activity.
Thanks, Juan Pablo. That was very helpful. So that's risk number one, top of mind, and that it feels like that can happen any day. It feels like oil prices can move $10 a barrel in a week. So we've got to watch that very carefully. Let's move to the next. What could go wrong? And I think chronologically that would be the UAW strike. Is that right, Mike? When you want to explain what's going on there and when potentially they could strike, and let's talk a little bit about what the economic implications of that might be.
Sure. The strike would start September 15th. We're recording right now. It's August 25th, 11 a.m. on the East Coast. And they should be announcing right now on Facebook Live that they voted for strike approval. So Sean Fain, the head of the UAW, he promised a more aggressive approach this time around to negotiating with the big three U.S. automakers. So that's Stellantis, Ford, and GM. And they're expected to approve strike today, and the strike will go into place on September 15th when their contract runs out. So digging in a little bit deeper, this time around, they're going after all three automakers. They usually go after one. If you remember back in 2019, the United Auto Workers struck against GM for 40 days. And instead of striking against all three, this time they're targeting all three automakers instead of just one. So that increases the risk to the economy right there. The impact to the macroeconomy is somewhat limited. So we talk about what the risk is. There's risks to locality. So you think of auto manufacturing towns like Lansing, Michigan, or Toledo, Ohio. There's a lot of risks for localities, but the risk to the macroeconomy from our investigation is pretty low. I think we used that 40-day strike in 2019 as our basis, and we saw that if they even increased it to all three, use the same duration of 40 days, it's still just about 0.3% off GDP in terms of economic loss from the strike. So it's not going to
would that be in the
over.
fourth quarter of the year annualized, or is that just quarter over quarter? Is that annualized impact?
No, it's just quarter over quarter.
So if I multiply by 4, is that 1.2 percentage points off of annualized growth?
That's, but if it kept on going, but it's just going to be off that one quarter.
Yeah, right. If it kept on going, right. Okay.
Yes.
Yeah. Okay.
But
okay. But you're saying though, if it's a 40-day strike, it's going to shave 0.3% off of growth. I can't just annualize that to get to 1.2%. I mean, roughly.
It's not annualized, so you wouldn't multiply it by 4 since the way it's calculated.
Okay, so you're saying it's 0.3 off of growth in the Q4.
Yeah.
Okay, so meaningful, measurable, but not existential in any sense of the word. If it's a 40-day strike.
Correct.
Okay.
And right now, the likelihood of it going more than 40 days, I'd put that probably about 40%. A strike at all, I'd put about 75% likelihood.
Okay.
Just the way that both sides are talking right now, they're not anywhere close in terms of where they would need to be to get a contract passed. But that 75%, they still haven't said if they're going to go after one company, they're going to do all three. They have said that they have about $825 million in their strike fund, which gets paid out to workers at $500 per week. So if they have about 150,000 workers, they all get paid $500 a week. That's 11 weeks that they could strike and still keep getting paid. So 77 days would be, and that's when the strike fund would run out if they're striking across all three companies. But of course, if they only struck against one company, then that would increase the duration that they could have that strike fund.
So you're focused on the lost output. So they go on strike, cars don't get produced, and that lost output, and I assume the multiplier, so-called multipliers, translates into that 0.3% impact, which again is meaningful, measurable, but not existential. I guess the other concern would be in the current context, kind of like, oil, is the inflationary effect. So, one of the kind of my thought was that vehicle prices are going to decline here over the next 6-9 months because we're getting more supply, primarily from Japan and Germany. They've been had supply chain issues because of the pandemic and Russian war, and they haven't been able to ramp things up as quickly. But that's now changing, getting more supply, more dealer inventory on dealer lots. Prices are starting to roll over, and that's going to continue. This UAW strike, though, feels like it would throw a monkey wrench into that, at least to some degree. Is that right?
Definitely. Yeah. So
Okay.
the last strike that we used as comparison, GM reported they'd lost about 900,000 units from production from that 40 days. So if you take out, we multiply that by 3.17, be the size of the three companies. I take that out to be about 30% of U.S. production for the quarter. And that would really cut into inventories. Inventories are about 70% below where they were coming into 2019. We didn't really see any impact on prices when that inventories came off in 2019, but they were stock full on the dealer lots. Now dealer lots are less full than they were. They're more full than they were last year, the year before that, but they're less full than they were in 2019. And so you should expect to see used vehicle prices, which have come down by 17% from their peak, according to wholesale numbers. We expect it, if there's another 40-day strike, we'd expect it to go up about another 10% on the used vehicle prices, and new vehicle prices. We also expect to see some increase in price, but not that significant. We were estimating about 5% for a 40-day strike.
Okay, let me ask it this way. How long a strike would there need to be for it to push us into recession? And assume like in Q4, without UAW or anything else going wrong, we're going to get growth that's kind of around 1 to 1.5% GDP growth. What kind of strike would take us kind of in a negative territory, do you think? Would it have to last all quarter for that to happen? Or
Yeah, it'd have to be over 90 days.
It'd have to be over 90 days. And you think if it was, then we'd come pretty close to that zero line.
Yes.
Okay. All right. And of course, the fact that we have less inventory and now more higher vehicle prices, or certainly not declining vehicle prices, that just makes it more difficult for the Fed to hold on to the current interest rate and not raise.
Yep. If we have housing prices going up and auto prices going up, and it's going to be tough to keep the pause on the interest rates, and that's going to be the real impact if the Fed isn't able to keep the pause.
Right. And I suppose the other point here is that the UAW is just an example of increased labor market strife, right? I mean, we've got all kinds of labor. It feels like, compared to the history of the past 20, 25 years, a lot of labor market actions going on right now.
Yeah, they see success. Unions see success at different companies. So you saw the UPS
deal.
Contract went through. They thankfully didn't have a strike where more supply chain issues would have happened. The Canadian port workers, you see them going on, and then when the unions see success in different places, I think that they call it the contagion effect, where other labor unions hold out for better wages, hold out for better terms of agreement.
Okay, so let me ask you, what's the probability in your mind of a 40-day strike?
Probability of 40-day strike is about 45%, I'd say.
Okay, and what's the probability of a 90-day strike?
5%.
Oh, you think it's very low?
Yeah.
Okay, so because they run out of cash and they want to settle.
Anything over 3 months, I'd say, is 5%. So maybe between 2 and 3, 25, 1 and 2, 45, just less than 1, 70, 75.
Okay, I was hoping for some symmetry. You'd say 35%. But okay, fair enough. It's less of a threat than that.
Yes, because they don't have enough in the strike fund to
Yeah.
stay that way.
Okay. All right. Anything else on this you want to bring up before we move on to Bernard and the potential government shutdown as what could go wrong?
Not unless you want to play the statistics game.
I do. We're going to play statistics game, and I got a good one actually. But I want to do one more. What could go wrong? And that's the government shutdown. And
Before that, I just wanted to say I got a news notification that I
Yeah.
think they authorized the strike like just a couple of minutes ago.
Oh,
So
did they? Okay.
Yes.
Yep.
All right. So Mike got that forecast right, is what you're saying.
exactly. Yeah.
Way to go, Mike.
I'll toot my own horn then, I guess.
Yeah, absolutely. Like Juan Pablo. Like Juan Pablo says, my forecast was damn good. Yeah.
Yeah, the pre-ballots were coming in at 95%, so I felt pretty confident on that one.
Yeah. But nonetheless, take credit, like I heard a great story. Oh, I digress. I won't digress. I was going to tell you a great story, but I'll tell you some other time. Let's move on to the government shutdown. So, Bernard, of course, the federal government's fiscal year ends at the end of September. On October 1, the new fiscal year, the government needs funding to remain open and continue to do business and continue to operate. That needs a piece of legislation. That feels like that's up in the air. So what are the prospects for the government shutting down on October 1 or at some point here in the near future?
Yeah. So I think before I get into that, I just want to set the stage just a little bit just to show how we got here.
Sure.
Because if you had told me a couple months ago that we'd be talking pretty seriously about the risk of a prolonged shutdown, I would have been a bit surprised, not fully surprised given gridlock these days, but still a bit surprised. Because if you go back to June, President Biden signed into law the Fiscal Responsibility Act, which resolved the debt limit crisis, but it also established limits on federal discretionary spending for the coming fiscal year, so fiscal 2024, as well as for fiscal 2025. And originally, I think you, me, everyone else, we were all hopeful that these spending limits would have reduced, if not eliminated, the potential for brinkmanship over the federal budget for this coming fiscal year. And my assumption was just that Congress would, without much fuss, or in a reasonably graceful manner, they would pass the 12 annual spending bills that fund all government operations. And then all these 12 spending bills would sum up to the limits established by the Fiscal Responsibility Act. And this assumption of mine was partly correct because the Senate has done just that. But unfortunately, it's the House of Representatives which continues to be the problem child. Back in June, many House Republicans were dissatisfied with the Fiscal Responsibility Act because they want to cut federal spending more than the agreed upon limits in the Fiscal Responsibility Act. So in June, you had a small block of Republicans who brought legislative action on the House floor essentially to a halt for about a week. And this was, overtly out of dissatisfaction to the debt limit deal. And so far, they've only passed one of the 12 annual spending bills. So we haven't really heard much at all about government shutdown risks thus far, and that's because Congress is right now in its August recess. But the House returns from its August break on September 12th. And at that point, they're only going to have 3 weeks left to pass their own 11 versions of those annual spending bills. Then they'll have to forge a compromise with the Senate before funding runs out on September 30th. So that's a very, very small period of time for some sort of a budget agreement for the next fiscal year to come about, especially when you have people who are, many Republicans who are just fundamentally dissatisfied with the limits on discretionary spending for these next for these next 2 years. Historically, what we've seen whenever, it's rare that we get a full year budget on October 1st or by October 1st. What typically happens is that we get a continuing resolution or a short-term spending bill that will fund the government typically through mid or early December. And then by then, that gives enough time for lawmakers to negotiate, come together, and pass a bill that funds the government through the rest of the fiscal year. But because of really the extreme dissatisfaction that many in the Republican Party have shown towards this towards the debt limit deal, I think that there's a possibility that they want to really take a stand shut the government down to really just, show their constituents or show their supporters that they're really fighting for lower spending. And as a result, I think the risks of a shutdown of any length, I would say, is about 50%. Shutdown lasting more than 2 weeks, and the reason why I say 2 weeks, because that's the typical pay period for a federal employee. I'd say probably a third, that we get a 3-week, 4-week shutdown, which would be similar to the record long shutdown that we got in 2018 and 2019. But I think there's a non-zero chance that we really do get an even, another record-breaking shutdown, maybe a month and a half, 2 months. And, we could also explore a scenario where it lasts the full quarter. And those, in that case, shutdowns, which generally have been non-events for the economy, I think would be a shutdown of that length would be potentially, it would help us it would bring the economy to the brink.
Yeah, we had Matt Robinson on a few podcasts ago, a very good political analyst, and he made me scared the heebie-jeebies out of me. He seemed to be attaching a pretty high, I don't know if that's a word, heebie-jeebie, but you know what I mean, heebie-jeebie. He attached a pretty high probability, very high, that we'd have a shutdown, and not an inconsequential probability that it would be prolonged. He was even contemplating it lasting through the end of the year, and ultimately resulting in that 1% sequestration, that cut across all discretionary defense, non-defense spending that was put into the legislation, the Fiscal Responsibility Act you mentioned previously. But since then, my sense is that things are moving in a more positive direction, that we've heard kind of sort of from Kevin McCarthy, the House leader, Speaker of the House, and even I think Mitch McConnell, the leader of the Senate Republicans, kind of sort of saying they didn't really want to go down the shutdown path. They were contemplating CR because historically, if you go back and look, it feels like the Republicans got blamed for previous shutdowns. And politically, that doesn't feel like something you'd want to do, get blamed for that in the lead up to the next election. Do I have that right? Or is that why
you have that right? I mean,
we
had the first presidential debate just a couple of nights ago. So the presidential
wasn't that just last night? Wasn't that presidential debate last night?
2 nights ago.
Oh, was it 2 nights ago? It's
yeah. So the
2
presidential, the 2024 presidential election cycle is underway. So it's I think both sides are going to try to refrain from a brinkmanship where they could potentially be blamed by the public.
Okay. And a good rule of thumb, and you've taught me this, and I'm just going to regurgitate it back and sound like I know what I'm talking about. But every week the government is shut down, shaves about 0.1% annualized off of a GDP growth, real GDP growth in the quarter in which it occurs. Probably a little less than that in the first few weeks, but a lot more than that after 3, 4, 5 weeks. So if you kind of do the simple arithmetic, if the shutdown began October 1, lasted through the end of the year, that would shave 1.2 percentage points off growth. And again, if growth without that was going to be 1.5%, that puts us right on the ledge, for recession.
Yeah.
Is that about right?
That's correct. But the key thing is that as every week that this lasts, or the longer that the shutdown lasts, the costs become even bigger and they become even more difficult to quantify. So the longer that the shutdown goes on, federal employees are not being paid, so they have to pull back on their spending. Then you have the whole constellation of federal contractors, throughout the country who also start to see stoppages in the work contracts that they were expecting from the federal government. So they also have to lay off, or, they also have to tighten the belt. And then I think the most obvious to everyone is for example, things like the national parks start to close. So areas in the country, tourism hubs in the country start to suffer from a lack of consumer spending. So over time, the costs really start to snowball, but it's just more difficult to game out what they are.
And just very quickly, correct me if I'm wrong, the longest shutdown was under President Trump for 35 days.
Yeah. And even that being the longest, it's that shutdown straddled 2 quarters. So the final quarter of 2018, where it shaved only 0.1% or 0.2%. And then in the first quarter of 2019, and again, that only shaved 0.1 or 0.2% that quarter. So it was very much on the margins. But I also think one last thing that I think is concerning is that when you have a shutdown, all of our favorite government statistical agencies are also shut down. So we have a data fog, and that's problematic for financial markets, for businesses, especially for us, that rely on these key government statistics to get a sense of where the current state of the economy is.
Well,
so that's
it's more likely we'll be right, right?
Yeah.
Pablo? It's more likely we'll be right if there's no data.
Yeah.
Yeah, just saying.
So,
Just saying.
so
I had one other thing. Oh, one last question, Bernard.
Mhm.
So how long a strike, or excuse me, shutdown would there need to be, do you think, to push us into recession?
it would have to last
The entire quarter?
through Thanksgiving, I'd say, for that to really be.
Oh, okay. Oh, only through Thanksgiving. Okay.
Thanksgiving, December. Yeah.
Something like that. Okay.
Yeah. And even if we get that 1% automatic spending cuts, it wouldn't help, but we still have to think that for this current fiscal year, we got a significant near 10% increase in the discretionary budget. And about 40% of that is going to bleed over into these next 2 years. So that would help ameliorate some of the hit to federal spending. So we wouldn't feel that cut necessarily this next year. But over time, that would hurt, and it would be a drag on the economy.
Got it. Okay, perfect. Okay, let's move forward. Let's play the statistics game, and then we'll come back to student loans and long-term rates. The game is we each come up with a statistic. The rest of us try to figure that out through clues and deductive reasoning and questions. And the best statistic is one that's not so easy, we get it immediately. One that's not so hard that we never get it. And it'd be great if it's apropos to the topic at hand. So, Cris, I'm going to go with you because these other guys are novices. So I'll let you go first.
Okay, we'll start easy too.
Okay.
Mine's not that difficult.
3.5%, the unemployment rate. Okay, is that it?
Close. 3.3.
Okay. What is it?
3.3.
3.3%?
Months.
Oh, 3.3.
Housing inventory.
Yeah.
Yes. What specifically?
Probably single family new housing at hand. That's roughly in. Is that? I looked at housing statistics yesterday, and I saw that number, but I don't remember quite what it was.
You might be playing a little bit with us, Martin. It might be like condo inventories or something.
No, I don't.
No, it's single family detached.
Is it existing or new?
New.
Oh,
no, it's existing.
It's existing.
Yeah, it's existing. Yeah, yeah. Oh, that's a good one. So explain that. That's a good statistic.
Yeah, so that number is rising a little bit, right? 3.3 months is still a very low level of months of inventory out there relative to history or pre-pandemic levels, but it's been increasing now over the last 6 to 9 months here. So things have been steadily moving in that positive direction, but mostly because sales are so low. Right? It's just that the level of sales activity is so low. It's not that you have a large number of people listing their homes for sale. Right? Those inventories in absolute terms remain very low. So just going to the Fed policies and high interest rates, we have mortgage rates now well above 7%, on their way to probably 7.5%, maybe 8% even. So we're going to continue to see a slowdown in home sales for the foreseeable future. And so that's going to be part of the outlook here in terms of potential negative.
Do you think the increase in inventory is consistent with kind of the narrative we've been thinking was going to play out, where because of life events, divorce, death, children, job change, that people, they don't really want to, economically, they don't want to move because they got a 3.5% mortgage. If they sell and buy and get another mortgage, it's going to be at 7%, and the cost is prohibitive. So they're really holding on, but at some point they just, there's no choice here. They got to move. And that inventory build we're starting to see is a reflection of that starting to happen, or do you think something else is going on?
Yeah, I think that's certainly a big part of it, right? To your point, the lock-in effect is even larger now, right? As the rates keep going on.
Yeah.
So my incentive is even stronger to some extent, although it's already pretty strong, right?
Yeah.
If I have a 3.5% mortgage. So I think there's that. You might have some shedding of second homes or investment properties to some extent, right? There is some weakness out there. Consumers are a little nervous about the future of house prices. You might see some inventory there, but that's pretty limited as well, right? There are not a lot of people with second homes that they're looking to offload at this point. So, but yeah, I think it's going to be a long, slow drag here to restore equilibrium.
Right. I think we have prices down now 5% peak to trough. The trough being sometime in 2025. Okay. That
Yeah.
was pretty good. Martin got that. I mean, I
Yeah,
was going to say it, but he beat me to the punch. So that's pretty good.
impressive.
Novice is really inappropriate. That was professional, I thought.
Yes.
Actually, well done.
Just got lucky. No, it's only 50% right.
And humble too. See Juan Pablo. See how that's done? That's humble. That's humble. Okay. Just I'm only joking. I'm only joking. Mike, you're up next. I can't wait to hear your statistic. I'm sure this is going to be like
11.5 million.
Is it vehicle related?
What do you think?
Oh, auto assemblies. Yeah.
11 point number of units. Cars, vehicles.
It is
11.5
the
million
number of vehicles, but what kind of
Assembled.
number?
Okay,
Yeah.
okay. Is that production? That's North American production of vehicles.
It's U.S. assemblies of motor vehicles, latest reading as of August 16th, the highest since that we've had in over 4 years. So
Juan Pablo, you see how that's done? I'm just saying. Now that's masterful, right?
Yeah.
Greatest of all time. Of course, I said North American production, but he threw a little monkey wrench in there. It's U.S. production. Are you sure, Mike? It's not North American. It's U.S.
100% sure.
100% sure. I knew you were going to say that. And your point is what? Why'd you bring that up?
U.S. production is above where it was in 2019 and July 2019. So we are fully back. We're above 2019's total produced at this point for North American production, or for you got me saying North American, for U.S. production, and so that's a signal that we will have more downward pressure on new vehicle prices and their substitute good used vehicle prices. If we're looking around the world, China, the largest producer of vehicles, they are above where they were in 2019. They are where they were last year, so they haven't slowed down production. Japan and Germany are both 20% above where they were last year. So we do have more coming online. If we don't have a major strike taking all these inventories, we should continue to see pressure, especially on the new vehicle side of things.
That's great. Okay, perfect. That was a great statistic. Okay, let's because I don't want to run out of time, and we've got a number of participants there. Although I've got actually a pretty good one. I might save it for next week. But Bernard, Martin, Juan Pablo, who thinks they've got a really good statistic?
I do.
I knew Bernard does. The Renaissance man, baby. All right, Bernard, you're next. What's
16,000. And this statistic literally came out within the past 30 minutes. I've been refreshing the BLS page for this statistic.
Oh, the BLS page. That's a big hint. 16,000. Oh, I know. No, I don't know. Does it have to do with the UAW strike?
No, but
it's in the strike report.
Yes, exactly.
And it's 16K but 16K.
It's the other big strike that's going on.
What's the other big strike that's going on right now? It's the Hollywood actors or writers, I should say.
Exactly. So
wait, Juan Pablo. I'm just saying
that was very impressive.
That is how it's done.
That's impressive.
That's thank you. He said that so nicely. That was Cris never says that to me. He never says that.
It's okay.
All right, Bernard, go ahead.
Yeah. So normally we don't focus at all on the monthly BLS strike report, but we are. I think this is a month where we are. We do need to pay attention because of all the strike activity. It's not just the forthcoming one potentially with the UAW, but we've had the writers' strike, and but even bigger, we've had the actors' strike. I was actually expecting this to be a much bigger number, because when you look at the labor at the media reports, it seems that the labor union, the SAG-AFTRA labor union, that represents about 160,000 actors, recording artists, and other media professionals. So
Bernard, let me stop you for a second. I think they actually, in the work stoppage report, they do have that separate.
they do, yeah.
That's separate. It's in there. The 160.
That's separate, yeah.
I think
But
this
for
is just the writers or something, maybe.
this is just the actors. This is
Oh, just the, I'm
actors.
sorry, just the actors.
The
just
actors.
Right.
And you have two types of strike reports. So you have the work stoppages program, but that's just any strike that occurs in the giving month. But the BLS strike report, these are strikes that affect more than 1,000 workers in a given establishment. And then these are strikes that occur throughout the pay period that includes the 12th of the month. So these, in order to, if a striker, in order for someone who's striking not to be included in the, in the monthly jobs report, they have to be in strike for the entire pay period that includes the 12th of the month. And that's not normally the case. Strikes you'll have a few days or a couple, or just depending on the timing, they might not show up. These strikes might not show up in the jobs report. But this Hollywood strike has been ongoing for the past several weeks. We expected that it would show up in the August in the August jobs report. And based on our preliminary forecast for August non-farm payroll additions was going to be 180K. But because of this strike report, we're now going to slash that down by a little over 16,000. So I think we could get a pretty weak jobs number, or a weaker jobs number, probably one of the weakest jobs number in a while. But I would just caution readers, or I would caution the audience that is in part due to some of these strike activity. It's not necessarily saying anything about the underlying fundamentals of the economy. So that's, in this case, in the case of looking ahead to the August jobs report, I think this monthly strike report took on added importance.
Great, that was a good one, very timely. Yeah. So, Martin, JP, I'm going to just move on because we're running out of time, and I want to get to the next what could go wrong. And let me now turn to you, Cris, and can you just give us an update on your thinking around the end of the student loan debt payment moratorium?
Sure. So unlike oil prices, interest rates, or even the UAW strike, there's no uncertainty about this one. Student loan payments are going to be restarting here in October, right? The moratorium actually ends at the end of August, and we have a month of September where statements will go out to borrowers telling them how much they owe and what the payments should be, where they should send them in. And then in October, they'll actually start submitting. We have we estimate about 24 million borrowers who are in forbearance today who will be at least eligible or required to start making payments in October. If we estimate about $300 as the average monthly student loan payment, that gives us around $7 billion a month, or $86 billion a year. I would say that that's the outside estimate of what the impact could be. That's if all of these borrowers did start paying that average amount immediately. There's good reason to believe that actually won't be the case because of several actions that the Biden administration has put forward here. One is that it is told the credit rating agent or the credit reporting agencies to not report out the delinquencies of borrowers who do not make their student loan payment. So the impact on credit reports would be minimal at this point if a borrower does not start paying right away. That order would go through what would exist for a year with the possibility of being extended. So it limits some of the incentive, if you will, or the necessity of making a payment right away.
Can I ask on that one, Cris, before you move
Yeah.
on, the 24 million, what's your sense? How many people won't pay because there's no real penalty for not paying? Because the services aren't going to report that to the bureaus. It's not going to ding their credit score.
Yeah, so my thought process is that, there were people who weren't able to pay before the pandemic, or certainly before the moratorium. There were people already in trouble, struggling to make their payments. Is around 10-15%. So I expect that same group here, even though there have been increases in wages and whatnot, that group is still facing a lot of financial pressure, right? These tend to be lower income borrowers, people who didn't necessarily finish their education, so they're not able to reap the benefit that would come from actually having a degree. So I expect that at least 10, 15% are not going to make a payment because they just aren't able to, right? They don't have the resources to, and that this additional executive order just makes that a little bit easier for them to make that decision, right? They're going to essentially, at a minimum, they're looking to extend some time here, maybe improve their finances, and then start paying again as needed. But on top of that, another reason to believe that even an even smaller share may actually start paying is that there are new repayment programs that have been introduced, particularly the SAVE program.
Mm-hmm.
So it's saving on a valuable education, I believe is the acronym, which would reduce the amount that borrowers have to pay to 10% of their income this year, and then 5% would be the maximum they'd have to pay next year. That depends on certain income qualifications, but that would reduce that $300 average, for example, down to maybe $250, right? So that's going to further reduce the impact here that restarting payments will have. So I'd estimate maybe it's 0.2 of a percentage point on GDP.
Oh, okay.
Growth.
Just 0.2.
Yeah.
Yeah.
So
if it was
something
80 billion, 80 billion is the outside maximum. If it was 80 billion, kind of do the arithmetic, that would be 1.2% of GDP, which would, because 80 billion out of 2.4 trillion is 0.3. Annualized, that's 1.2%. So you're basically at zero. If everyone started repaying and they didn't, and they cut all their other spending consistent with that payment, and that's not going to happen. So you're saying, after accounting for the income driven repayment plans, after accounting for the fact that people just aren't going to pay because they're not going to get dinged, after accounting for the fact that some have lots of resources, they're not going to cut back at all just because they're going to be shelling out $300-400 more a month, it comes out to 0.2%. So again, like the UAW strike, meaningful, measurable, but not at all existential.
Yeah, on its own, not enough.
On its own.
If we start layering all these factors in, right, we get an oil shock on top of this. Maybe, certainly this is going to have some impact. But right. If this is if the student loan repayments are the only thing that happens, it's going to slow things down, but not materially. Yeah,
and then one thing that folks are concerned about, clearly in our world, in some of our clients, is, does this mean that delinquencies on other liabilities are going to rise? Because cards or consumer finance loans, they're already suffering pretty significant increase in delinquency default. Is this going to add to that to any meaningful degree?
It'll add some. I believe, but I think that because of that order that for delinquencies not to really affect your credit, at least not in the short term, the payment hierarchy, the ordering of payments for student loans is probably going to be pretty low, right? I'm going to pay my auto loans and credit cards first because the impact is greater if I don't.
Okay. So it feels like, and we're going to go now to interest rates, but it feels like all these things we've been talking about are by themselves not enough to do us in. But obviously, if more than one or a bunch of these things happen, that could be pretty quickly enough to do us in. Right.
I think so. And they also are compounding, right? They'll drag on over time.
Yeah. Right. Okay. All right. Let's turn to that last, what could go wrong. And I should, before we do this, preface this by saying there's a lot of things that can go wrong. We're only picking off a few of them, the ones that seem most pressing, most immediately given events. And next up is this recent surge. I don't know if surge is the right word, but this significant increase in long-term interest rates. So the benchmark here is the 10-year treasury yield. If I go back, I don't know, correct me if I'm wrong, Martin, 4-6 weeks ago, it was sitting 3.75. The 30-year fixed mortgage rate was just north of 6, something like that. Now we're sitting at 4.25, 4.3 on the 10-year, and the 30-year fix is now, I think, hit a new high. It's at 7.25 or something like that, 7.30, something like that. So it's moved up quite a bit. So first question to you is, what's behind this increase? And then, of course, I'm going to ask, what do you think where we're headed here, in terms of the increase?
Okay. Yeah, so 30, 40 basis points in a month is a bit. It's also high in level by comparative historical standards, where the yield was around 2.5% in the 2010s. Now, the interest rate is a price like many other things, and the way the economists think about this is in terms of supply and demand, right? It's the price that the Treasury, for instance, pays to borrow over the next 10 years that lenders are requesting to basically be willing to lend. And over the past month or so, there's essentially 3 factors that play roughly with equal weight, I should say. The first one is the realization that the US economy is doing better, recession risks are fading, and that has caused the Fed to most strongly signal that rates will have to remain high. Fed has signaled that for a while, but markets weren't necessarily believing that as much. If you go back a couple of months, a lot of market participants still expected cuts, either even late in 2023 or in early 2024. By now, that's shifted pretty firmly, as we discussed earlier, into later the year. And longer-term rates, in part, are an average of expected short-term rates. So as this expectation rises, the long-term rate comes up a little bit. The second component is expected inflation. That was also already discussed. Yields are nominal, right? If I want 2% after inflation, I think expected inflation is 2.5%. I have to ask for a nominal yield of around 4.5%. Oil plays a big role in this. Bond traders especially keep an eye on this because obviously it's an important driver of inflation. And the third component is a little bit more technical, that has to do with risk perceptions ultimately. What is embedded in long-term bonds is what we refer to as a risk term premium. And it's basically the risk that you as an investor take on by locking yourself into, say, a 10-year bond today, versus holding 10 successive 1-year bonds. The reason why that is broadly speaking, both of these strategies should roughly pay you the same amount, right? The same annual interest rate should be the same on both of these. But the problem is we don't really know what future interest rates are going to be, right? So they have to make a guess on what the 1 year is going to be, a year down the road, 2 years down the road, and so forth. And financial markets do this all the time, but there's an error around that guess. So if I'm getting that wrong, I may end up doing worse by holding a 10-year, which is fixed in rate. And that's the term premium in essence. It is associated with all sorts of risks, that we get inflation wrong, that the Federal Reserve becomes less competent in hitting inflation target, that there's more quarreling, for instance, about budget and so forth. The term premium is still very low by historical standards, so it's not per se a red flag. It's negative, but it did tick up a little bit in the last 4 weeks, and that contributes to rising yields.
So it's a combination of inflation expectations, inflation volatility and uncertainty. So inflation generally. Second, you mentioned the term premium. That's the yield spread that investors demand for buying a long-term versus a short-term bond, although weirdly it's negative, but we won't even go down that path. And the third is higher real short-term interest rates because the economy feels like it's been performing more strongly, and that's getting embedded in expectations around what the Fed's going to do with short-term interest rates. And this run-up, this 0.5 point increase or so in long-term 10-year Treasury yields is due roughly in equal measure to each of these factors. Is that roughly right?
That sounds right. I mean, the one that's ticked down a little bit in the last couple of days is the inflation expectation, but it's still a little elevated compared to where it was a month ago.
Okay, so say we're at 4.25. Our baseline is this is it. We're not going any higher than this. I mean, in the long run, we expect the 10-year Treasury yield to be equal to the nominal potential growth rate of the economy, nominal potential GDP growth, which is 4%, 2% real GDP growth, the real potential growth of the economy plus 2% inflation. And we're kind of sort of there. And, this is a market, like any financial market, there's speculators and momentum players. So it can go above this for a while, below this for a while. But right now it's 4%. So that's kind of our forecast. This is the end of the story right here. Fixed mortgage rates, they're elevated. The spread is very high by historical standards, and we won't go down that path either. But over time, we expect that spread to get back to something more normal, which would suggest that the 30-year fixed rate loans should settle in somewhere 5.5, 5.75. And again, we're over 7%. That's the baseline. Does that sound about right to you? And what are the risks to that for higher rates, lower rates here in the near term? What do you think?
Yeah, so there's two questions, right? So one is near term and what's the equilibrium rate? In terms of near term, I think breaching something like 4.5% is pretty probable, actually. And the reason for that is twofold. For one, there is still
see how you said that pretty probable, but that's like open to a gazillion interpretations of what, pretty probable. Is that like, in my interpretation, that's over 50% probability. Is that right?
I would think so, yeah. And
okay, fine.
I'll give you my thinking around that. I mean, we've already been at 4.36%, right? It's 15 basis points. It's not a lot, right?
Yeah.
The expectations don't have to shift a lot. There is still a segment of the market that's pricing a recession risk, right? So if you look at CME futures as a rough proxy, as of today, about 20% expect a cut in March. Yesterday, before the Jackson Hole speech, was closer to 30%. So there are still traders in the market that have a more bearish outlook on interest rates. If recession risks continue to fall, which is our assumption, they're going to come around, and that's going to shift expectations a little bit by pure just market movements. Inflation risk, right? If the energy thing comes up, that also has the potential to push yields a little bit higher. And then, of course, the question is, what's the Fed going to do? I mean, the Fed roughly has a sense that they are where they need to be. Economic data still kept accelerating through the second quarter, but monetary policy acts with lag, so it might take some time for that to really fully play out. If the Fed is wrong about that, or if they think they're wrong about that, there's always the risk that they're going to pivot again, right? So in factoring all of that in, just the shift from we no longer expect a recession broadly versus most people in March expected a recession, plus inflation risks, plus the Fed pivoting, I would say at least breaching it is more likely than not. If it's going to sit there is a different question, right? So if you're going to end up at 5.5%, that's probably less likely. I think that's probably less than 50% significantly.
So because it is a market, it can move, feels like it can move 15 basis points in like an hour. Getting 4.5 that seems pretty probable, is what you're saying. Seems
yes.
But you're saying it's unlikely it's going to hang there to the degree that it would do a lot of damage.
Well, carefully, I'm going to say yes to that. I don't think that's unlikely.
Okay.
Of course, the problem in financial markets is always when rates raise above a certain level, things can break. We don't exactly know what can break, so there's uncertainty around. The risk is always there, that for sure. I don't think it's particularly likely, though.
Right. Okay. And what about my kind of frame around where the 10-year yield should be long run, the 4%, the nominal potential GDP growth? Mm-hmm. What do you think about that frame? Is that a useful frame? Do you agree with that?
I think so. I mean, so the way the economists think about the long-term rate in general, it's the rate that prevails when the economy is in equilibrium. So when there is potential growth is equal to actual growth, where we're not in recession, the economy is not overheating, nothing like that. And historically speaking, we don't know what that is because we're not usually at equilibrium, so we have to estimate it. For most of the historical period, the estimates you find since the 1960s for the real equilibrium rate pretty much track potential growth. And so you add 2% inflation to that, that gives you the long-term value. There are some complications around this. If you look at estimates after 2008, they actually come in significantly lower. It's about a 50 to 100 basis point. A lot of that is associated with the Fed's quantitative easing. And it's a city that the Federal Reserve went out and bought trillions of treasury bonds that may have depressed the level a little bit. Of course, the Fed has reverted that over last year, at least in part, is rolled off $1 trillion. And the question is, as that continues, is that effect going to go away, right? So that's one of the factors that plays into this. There's other factors that could go the other way. For instance, if the Treasury keeps racking up debt hypothetically, right? So debt to GDP is pretty high. That's currently well over 100% of GDP. If we keep racking up deficits, eventually credit risk becomes a problem, right? So lenders, bondholders might be concerned about the long-term ability or willingness of the US government to repay that. That would push the long-term rate up over potentially what it is right now, right? And there's literally 3 or 4 or 5 other theories that are out there that create a deviation. But for a benchmark, thinking about it in terms of productivity growth, population growth, plus expected inflation, I think is a pretty good baseline.
Yeah. One last question, and this may be an unfair question. So what 10-year Treasury yield do you think would be necessary for what length of period to do us in? And then the answer may be it depends on why long-term rates are higher. But answer that question any way you want to answer it. Or you could say, Mark, I'm not answering the question.
Yeah, I'm not really.
Bernard will then answer the question because he is the Renaissance man and he knows the answer.
So the reason why I don't have an answer for that, I think if the conventional sort of economic wisdom is correct, I don't think it would be a whole lot higher. I mean, you're looking literally at maybe in the vicinity of
he's so good. He could be
25, 50 basis
pretty
points.
probable, all these.
Yeah, basically I'm saying nothing.
He's
Yeah,
data
exactly.
dependent.
Yeah.
It's
Fair
data
enough.
dependent, that's right. So the reason why I don't think if the current economic wisdom is right, if the Fed tightens a lot more, it's a bit like the oil price, right? So by where we think we are in terms of equilibrium, we look very restrictive. But of course, the concern is, and Cris had spoken to this earlier, the labor market still looks, by historical standards, very strong. Consumption is picking up and so forth. And maybe the thinking then is, well, it's possible that the neutral federal funds rate is higher than what it is. And if that's the case, then we're not actually that restrictive, which in turn also means the 10-year has room to go higher. The thing that I'm from a practical perspective concerned, because that's what I do, is how much can the banking system take? How much can the stock market take? Right? And a lot of that looks stretched, as we know. I mean, we've seen the banking turmoil in March. There's other areas of exposure. It's not just securities, it's CRE. A lot of that is going to come due next year. What's credit risk going to be if the 10-year picks up on that as people try to refinance these loans? And it's a bit of a black box because in part the data doesn't exist. And the thing about financial crises is it usually only takes a couple of bad eggs. Right? If you have one or two players that look really risky, it can infect the entire system. Quantifying that probability is hard. If that's going to hit at 10%, at 50 basis points more or 75, it's hard to say.
Good. Yeah, I think that's a good answer. It's a tough one. Hey, we're at time, but I want to end with one last question to Cris. So, Cris, you see how I kind of frame this, what could go wrong. I picked my kind of 5 likely candidates of what could go wrong here most immediately. If you had to pick another one, what would it have been? Because you are the relative bear, so I'm sure you're thinking about this all the time, and you've made the point that if we're going into recession, risks are so high because there's a lot of we're fragile, we're growing slowly, and there's a lot of what could go wrongs out there. What else would you throw into the mix that we didn't consider?
Well, my top, I think we considered is the top is just Fed makes a mistake here, right?
Yeah.
Or a bit of a data fog. There are lags in the data, right? They're trying to do their best. They're juggling multiple objectives. So that would be top of the list. The one we haven't really touched on all that much is a credit crunch, banking credit crunch.
Yeah.
Right. We made it through the spring and looks like the banking system has settled down. But as Martin pointed out, there are still lots of risks to the banks out there.
I view that as kind of an evergreen, what could go wrong. These others are more, here and now, but you're absolutely right. That's clearly a threat at any point in time.
And I see that as an accelerator, right? You get some of that interest rate hike activity going on, and suddenly, CRE values are impacted and the banking system starts to unravel, right? So that's my preoccupation, is that there are some additional risks out there that just get enhanced by even a relatively minor shock. Yeah.
Okay, fair enough. I think we're going to call it a podcast. We covered a lot of ground, and I think I found it very I'm going to toot my own horn. I thought this was a well-designed podcast, right? Juan Pablo, you see how I do that? I'm going to take a little bit of credit for that. Well-designed podcast, but only because I've got great colleagues who know what they're talking about and can really provide a lot of insight on all these topics. So thank you guys. And dear listener, I hope you found this of some value, and we'll talk to you next week. Take care now.